Money is changing. From bartering shells and stones, we moved to precious metals. Then came paper money, backed by gold. Now much of our money is already digital, zipping between bank accounts. But something new is stirring. People are looking at money differently. They are asking big questions. What gives money its value? Who should control it? Can we make it better, fairer, and more accessible to everyone on this planet? This curiosity is driving a global conversation. Financial crises make us question the stability of old systems. The rise of the internet has shown us the power of decentralized networks. We see how information can flow freely, without a central gatekeeper. So, people wonder, could money work that way too? Could we have a financial system that is more open, more transparent, and perhaps even more democratic? These are not just idle thoughts. They are the seeds of potential revolution. The digital age has brought incredible innovations. We can connect with anyone, anywhere, instantly. New forms of currency are emerging, born from code and powered by cryptography. They promise a different way of thinking about value, ownership, and trust. This isn't just about new technology. It's about new possibilities for how we interact financially. This journey starts with understanding the money most of us use every single day. So what is this money we use daily? It's called fiat money. Think of the US dollar, the euro, or the Japanese yen. These are all examples of fiat currencies. The word fiat comes from Latin. It means let it be done, or it shall be. Fiat money is currency that a government has declared to be legal tender. This means you can use it to pay taxes and settle debts by law. The value of fiat money isn't backed by a physical commodity like gold or silver. Instead, the value of fiat money comes from trust. It relies on our collective faith in the government that issues it. We trust that the government will remain stable. We trust that it will manage the economy responsibly. This trust is the bedrock of the fiat system. If that trust erodes, the value of the currency can suffer dramatically. Think about countries where there is high inflation or political instability. Their currencies often lose value quickly. Fiat money is the dominant form of currency worldwide. It's what you get paid in and use to buy groceries, pay rent, and save for the future. Who manages fiat money? That responsibility falls to central banks. Think of the Federal Reserve in the United States or the European Central Bank for the Eurozone. These institutions are like the guardians of their respective fiat currencies. Their primary goal is usually to maintain price stability. This means keeping inflation low and predictable. They also aim to foster economic growth and ensure the stability of the financial system. Central banks have several tools to manage the money supply. One key tool is setting interest rates. When a central bank raises interest rates, borrowing money becomes more expensive. This can slow down economic activity and help control inflation. Conversely, lowering interest rates makes borrowing cheaper. Central banks can also buy or sell government bonds. This action, known as open market operations, directly injects or removes money from the economy. The supply of fiat money is centrally controlled. Central banks can decide to print more money or reduce the amount in circulation based on their assessment of economic conditions. This concentration of control is a key characteristic of the fiat system. Now let's turn our attention to cryptocurrency. What is it? At its core, cryptocurrency is digital or virtual money. It exists only in electronic form. You can't hold a physical Bitcoin in your hand like you can a dollar bill. It's secured by cryptography, which is a method of protecting information using complex codes. This makes transactions secure and helps control the creation of new units. A key feature of many cryptocurrencies, like Bitcoin, is decentralization. Unlike fiat money, which is controlled by central banks and governments, many cryptocurrencies are not managed by any single entity. Instead, they operate on a distributed ledger technology, most commonly a blockchain. A blockchain is like a shared public record book. Thousands of computers around the world keep copies of this ledger. This makes it very difficult for any one person or group to tamper with it. This decentralized nature means there's no central authority to decide when to create more money or to freeze accounts. Section 5. Bitcoin and Ethereum, pioneers of a new era. When people talk about cryptocurrency, Bitcoin is often the first name that comes to mind. It was the very first decentralized cryptocurrency, launched in 2009 by an anonymous person or group known as Satoshi Nakamoto. Bitcoin was revolutionary. It showed the world that a digital currency could exist and function without a central bank or administrator. Its main purpose was to be a peer-to-peer electronic cash system. Bitcoin's success paved the way for thousands of other cryptocurrencies. One of the most significant of these is Ethereum. Launched in 2015, Ethereum took the concept of blockchain technology a step further. While Bitcoin is primarily focused on being a digital currency, Ethereum is more like a decentralized global computer. It allows developers to build and run decentralized applications, or dApps, on its blockchain. Ethereum introduced the concept of smart contracts. These are self-executing contracts with the terms of the agreement directly written into code. Section 6. Head-to-head, fiat versus crypto. The core differences. Let's compare fiat money and cryptocurrency directly across a few key areas. First, consider control. Fiat money is centralized. Governments and central banks control its supply, its rules, and its infrastructure. They can print more money, set interest rates, and even freeze accounts. In contrast, many cryptocurrencies like Bitcoin are decentralized. Their rules are set by code and maintained by a distributed network of participants. No single entity has complete control. Next, let's look at supply. The supply of fiat money is generally elastic. Central banks can increase or decrease it based on economic policy. This flexibility can be good for managing economic cycles, but it can also lead to inflation if too much money is created. For many cryptocurrencies, the supply is often fixed or predictable. Bitcoin, for example, has a hard cap of 21 million coins. This limited supply is one reason some see it as digital gold, a potential store of value. Storage is another important difference. Fiat money can be stored physically as cash or digitally in bank accounts. Cryptocurrencies are stored in digital wallets. With crypto, you can be your own bank, meaning you have direct control over your private keys. Section 7. Fiat money strengths and weaknesses. Fiat money has been the dominant system for a long time, and for good reason. It has several strengths. One major advantage is its stability, at least in well-managed economies. Central banks actively work to keep inflation in check and ensure the currency maintains its purchasing power over time. This predictability is crucial for businesses and individuals to plan and make long-term financial decisions. Another strength is widespread acceptance. Fiat currencies are universally accepted within their respective countries and often internationally. You can use your US dollars or euros almost anywhere to buy goods and services. The infrastructure for fiat, like banks, ATMs, and payment processors, is well established and convenient for most people. However, fiat money is not without its weaknesses. The centralized control, while sometimes a strength, can also be a vulnerability. Governments can mismanage economies, leading to hyperinflation that destroys the value of savings. Political decisions can impact the currency's stability. Furthermore, the ability of central banks to create more money can lead to a gradual devaluation of the currency over time. Section 8. Cryptocurrency, the promise and the perils. Cryptocurrencies offer an exciting set of potential benefits. One of the most significant is financial inclusion. For people without access to traditional banking, cryptocurrencies can offer a way to store value and make payments using just a smartphone and an internet connection. Another major appeal is lower transaction fees, especially for international payments. Sending money across borders using traditional methods can be expensive and slow. Crypto can often do it faster and cheaper. Decentralization is another key promise. By removing central points of control, cryptocurrencies aim to be more resistant to censorship and single points of failure. If you hold your own private keys, no bank or government can freeze your assets without your consent. However, the world of cryptocurrency is also fraught with challenges and risks. Volatility is a major one. The prices of cryptocurrencies like Bitcoin and Ethereum can swing wildly in short periods. This makes them risky as a short-term store of value or for everyday transactions where price stability is important. Section 9. The future of money: coexistence, competition, or transformation. So what does the future hold for fiat money and cryptocurrency? It's unlikely to be a simple case of one completely replacing the other, at least not in the near future. Instead, we are more likely to see a period of coexistence, competition, and perhaps even integration. Each system has its own strengths and weaknesses, making them suitable for different purposes and different people. The world of finance is becoming more diverse, offering more choices than ever before. Fiat currencies will likely remain the backbone of national economies for the foreseeable future. They are deeply embedded in our legal and financial systems. Governments rely on them for taxation and monetary policy. For everyday transactions, paying salaries and large-scale commerce within a country, fiat money's stability and widespread acceptance are hard to beat. Central banks are also exploring their own digital currencies known as CBDCs, which could modernize fiat systems while keeping central control. Cryptocurrencies, on the other hand, may find their niche in specific areas. They could excel in international remittances, offering faster and cheaper cross-border payments. They might serve as a store of value, a digital gold, for those seeking an alternative to traditional assets, especially in times of economic uncertainty or high inflation in their local fiat currency. The technology behind crypto blockchain also has vast potential beyond currency, for things like supply chain management, voting systems, and digital identity. Ultimately, the future of money will be shaped by trust and utility. Which systems do people trust more? Which systems offer them the most value and convenience for their specific needs? Understanding both the familiar world of fiat and the emerging landscape of cryptocurrency allows us to make more informed decisions. The ultimate showdown isn't about one winning and the other losing. It's about finding the right tools for a more efficient, inclusive, and resilient global financial future.